Silver collapsed 31% to finish the week below $80, suffering the largest daily loss ever recorded. Not the biggest in a decade, not the biggest in 50 years, the biggest on record, period. $7 trillion was erased from precious metals in a single trading day. Silver dropped 31%, wiping out roughly $2 trillion. Gold fell 11%, erasing approximately $5 trillion. Platinum slid 20%. Palladium plunged 16%. And what I'm about to show you proves this wasn't random. This wasn't organic panic. This wasn't a natural market reaction. This was engineered. And I have the evidence. If you look closely at the latest COMEX report, JPMorgan closed its silver short positions exactly at the absolute bottom of the crash. From that moment, prices began to rebound. That's not coincidence. That's not speculation. That's documented proof the entire Friday collapse was planned. Looking at the channel stats, roughly 3 out of 4 of you watching right now are not subscribed. If this content cuts through the noise and helps you see markets more clearly, hit subscribe. That's how I know the serious community is growing. If you're getting real value here, comment silver. It helps me and my team understand what resonates and how to better serve this audience. If this isn't for you, no hard feelings. I'm not chasing vanity metrics. I'm focused on people who want unfiltered truth, not the polished, misleading, and often out-of-touch narratives pushed by mainstream sources. Now, let me walk you through exactly what happened. The COMEX report dated January 30th, 2026 shows JPMorgan Securities stopped 633 silver contracts precisely at the bottom. Price collapsed from above $100 into the low 70s. And at the exact low, JPMorgan closed 633 short positions. Immediately after, prices began to recover. This isn't theory. This is verified COMEX data. And here's the second smoking gun. A total of 2,514 February silver futures contracts have already been issued delivery notices. Physical demand hasn't slowed. On January 30th alone, COMEX Silver traded roughly 368,561 futures contracts and 28,152 options contracts. Each silver contract represents 5,000 ounces. That's about 396,700 total contracts, or roughly 1.98 billion ounces of silver traded in one day. Let me repeat that. Nearly 2 billion ounces in a single session. Annual global mine supply is only 800 to 850 million ounces. More than double annual production was traded in one day. That's not price discovery. That's liquidity control using synthetic ounces. Now, connect the timing. The U.S. government moves toward a shutdown. Then the Senate passes a bill to avoid it. The first U.S. bank failure of 2026 hits. Chicago-based Metropolitan Capital Bank and Trust collapses after regulators close it for unsafe conditions and weak capital. Assets of $261 million, deposits of $212 million, a $19.7 million hit to the FDIC fund. Polymarket odds of a U.S. bank failure on January 31st surged to 99%. Something big was coming. Liquidity tightens across the system, and right on cue, paper silver gets obliterated. Perfect timing. Totally organic. Just a coincidence, right? Wrong. Dealers suspend trading. Delivery times stretch to 8 to 16 weeks. Inventories disappear. Physical premiums decouple. Meanwhile, the paper market dumps multiple years of global silver production in a matter of hours. Paper markets flush fear. Physical markets clear reality. And when governments stall, banks fail, and trust fractures, real metal doesn't return to the market. It vanishes from it. Here's what you need to understand next. Shanghai spot silver is currently trading around $122. COMEX closed near $84. That's a $37 premium, even after a 31% crash, the largest daily drop ever recorded. Physical silver in China is trading roughly 44% above COMEX prices. The premium didn't shrink. It didn't disappear. It expanded. Now let me address the two types of viewers watching this. First, the long-term stackers, which make up roughly 70% of this channel. Many of you have been stacking for decades. You have a plan and you stick to it. Your time horizon isn't daily or hourly. It's measured in months and years. You let time do the heavy lifting. A 31% crash doesn't shake you. You see it as opportunity, whether that means buying now or waiting for further downside. Fundamentally, nothing has changed. In fact, the elevated Shanghai premium reinforces the widening gap between paper and physical markets. You're calm, you're focused on the macro picture. Even after this move, we're still up about 19% on the monthly close. Volatility doesn't scare you. Then there are the short-term traders, especially those without a plan who believe markets move in straight lines. For you, this was devastating. A 31% daily drop with leverage is a liquidation event. Some may have profited, but if you were over-leveraged, positioned incorrectly, or trading emotionally, this move wiped you out. Forced liquidations don't care about your thesis. I've warned about this repeatedly. Over-leverage, short-term trading without discipline. Go back and watch previous videos. If you're new, start there. If you've been here from the beginning, you knew this was possible. We had a plan. For anyone new, let me be clear. I don't sell signals, courses, or mentorships. The real OGs know that. My handle is OG John AG on both YouTube and Twitter. If you're not following there, you're missing real-time analysis. We discussed the possibility of a move to $86 and below after the Fed chair pick, and it happened. The real ones already knew. Be aware there are fake accounts repackaging my work, altering numbers, and pushing false narratives. I'm not responsible for that. Verify the handle. Follow the real account. I don't push fear or greed. I don't give signals. I don't take sides. I give data, context, and the truth. Use your own judgment. Know which camp you're in, long-term stacker or short-term trader, and act accordingly. Now let's break down what the COMEX report is telling us. JPMorgan closed 633 silver shorts at the exact bottom, not near it, at it. Then price recovered. That's proof the crash was timed, controlled, and executed with precision. They know where the bottom is because they create it. They dump massive paper supply, trigger cascading liquidations, trip every stop, flush weak hands, then close shorts at the low. It's a flawless trade, and it's visible in the data. Here's the midpoint reveal that reframes everything. This wasn't a correction. It was a deliberate paper massacre. Gold down 10%, silver down 31%. This wasn't normal market behavior. It was driven by massive futures selling by major banks. No new physical gold or silver was created. Fundamentals remain intact. Physical investment demand is strong. Central banks continue buying gold. Silver supply remains tight. Mine output grows slowly while above-ground inventories drain. Industrial demand stays relentless, driven by solar, electronics, EVs, and more. That creates a firm floor, especially for silver. Miners now have a base to rebuild from. Mining equities are positioned to double over the next 6 to 12 months as volatility fades and the bull market resumes. Again, 1.98 billion ounces of paper silver traded in one day versus 800 to 850 million ounces of annual mine supply, while physical buyers face 8 to 16 week delivery delays, while Shanghai premiums sit at $37, while COMEX delivery notices total 2014 contracts. Paper and physical markets are completely disconnected, and the proof this was planned is right there. JPMorgan closed 633 shorts at the bottom. Add the final catalyst, the first U.S. bank failure of 2026, Metropolitan Capital Bank and Trust. Polymarket priced 99% odds. It happened. Not systemically important, but it's the first. And once the first bank fails, liquidity concerns spread. Counterparty risk rises. Trust erodes. The initial response is liquidation. Everything gets sold, including gold and silver. But then comes phase 2. The realization that the system is fragile, that banks are failing, that trust is breaking. That's when safe haven demand returns. That's when premiums explode. That's when physical demand surges. We're between phase 1 and phase 2 right now. Now the bearish case. A 31% daily crash is catastrophic if you were positioned wrong. This matters. Leverage got wiped. Tight stops were triggered at the worst prices. Overexposure destroyed accounts. Technical damage is real. And CME is now raising margins on COMEX gold and silver futures after historic declines. Margin hikes after a crash add fuel to the fire. Survivors now need more capital or they're forced out, creating additional selling pressure. If more banks fail, if liquidity tightens further, if credit conditions worsen, we could see more forced selling across assets. In early crisis stages, everything is sold to raise cash. Safe havens come later. Paper markets can stay irrational longer than traders can stay solvent. 7 trillion vanished in a day. There's no guarantee volatility is over. But here's why the bearish paper case doesn't change the bullish physical case. JPMorgan closed 633 shorts at the bottom. That's data. Delivery notices are rising. Physical demand persists. Nearly 2 billion ounces of paper traded in one day. Shanghai premiums remain at 44% after the worst crash ever. In real crashes, premiums collapse. This time they widened. Physical buyers in China are paying nearly 50% more than New York paper prices after the biggest silver crash in history. That's not a broken bull market. That's a paper system losing credibility. Dealers halt trading. Delivery delays stretch. Inventories vanish. Physical premiums detach. Paper markets dump the equivalent of years of production in hours. This is the endgame behavior of a system under strain, executing one last flush before reality overwhelms it. So where does this leave us? 3 takeaways. First, JPMorgan closed 633 silver shorts at the exact bottom on January 30th, documented. Not coincidence, proof the crash was planned. Second, 1.98 billion ounces of paper silver traded in one day versus 800 to 850 million ounces of annual mine supply, while physical premiums remain elevated and delivery delays persist. Paper is fiction. Physical screams deficit. Third, the first U.S. bank failure of 2026 is here. Liquidity is tightening. Trust is cracking. Phase 1 liquidation is underway. Phase 2 flight to safety is coming. CME margin hikes confirm systemic stress. The unresolved question is this: do we see another wave of forced selling? Or does physical reality reassert itself now that shorts are closed and weak hands are gone? How many more banks fail? When does the flight to safety begin? 7 trillion erased. Largest daily silver loss ever. First bank failure of the year. 2 billion ounces of paper dumped in a day. JPMorgan closed 633 shorts at the bottom. That's the smoking gun. The crash was planned. And the physical market is telling you the paper system is living on borrowed time. Do your own due diligence. Understand the risks. Leverage in this environment is lethal. But if you understand what's actually happening, this move isn't about fundamentals. It's about desperation. One final flush before the paper system breaks. Invest with logic, not hype.